Hello everyone, my name is Ding Lu. Today I'm going to do the presentation on value investing. As you will see, it is a simple but not easy investment strategy that everyone can apply. So this is the overview of this presentation. First, I'm going to go over the value investing concept, and then I will choose 8 super investors to construct a super investor index. And then I go on to compare the performance of super investor index with market index, see if they really outperform the market. And then in the end, there will be some discussions. So what is value investing? Value investing is investing stocks that trade for less than their intrinsic value. So intrinsic value here is the actual value of the company, and most of the time it is different than the market value of the company. So when the market value is less than intrinsic value, and then there presents an opportunity for value investors to invest. And according to Benjamin Graham, the gap is called the margin of safety, and it should be at least 33% of the intrinsic value. So how do we calculate intrinsic value? There's various methods to value a company, and then one of the most widely used one is called discounted cash flow analysis. So basically for value investors, they need to go out and do the fundamental analysis, and through the analysis they will be able to estimate the future cash flow, the discount rate, and growth rate of the company, and then they will be able to calculate the intrinsic value and compare to the market value, see if there's a margin of safety or if the margin of safety is big enough. So when we talk about value investing, we often mention growth investing because to many investors there are two different types of investment strategy. For value investors, they are looking for the margin of safety, the intrinsic value. But for the growth investors, they are looking for just the growth of the company because they believe the stock price of that company is directly linked to the company's future growth, which obviously is not always true, but they believe in that. And so if the company is believed to grow in the future, and then the stock price will also grow. So that's the growth investors' mentality when they go out and invest. One of the articles I read the other day talked about the difference between these two, and it kind of makes sense to me, so I want to share with you guys. In author's opinion, they are in a sense the same type of investment strategy because it's all based on the investor's expectation. So for value investors, they invest in stocks with low expectation, such indicated by low PE ratio, low PB ratio, and then they believe the factor causing stock to be undervalued are only temporary in nature. So when those temporary conditions passed, the expectation will increase, and then which eventually leads to the increase in stock price. And that's for the value investors. For the growth investors, they invest in stocks with high expectations already, which indicated by high PE ratio, high PB ratio, low dividend yield, and so on. But they still believe, compared to future expectation, the current high level expectation are still too low. So if speaking about the investors' expectation, and they're all the same, either from low level to high level or from high level to even higher level, they are in a sense the same. And efficient market hypothesis. So efficient market hypothesis asserts that financial market is informationally efficient. They have 3 major versions: the weak form, the semi-strong form, and the strong form. So for the weak form, it claims that the price will just reflect all the past publicly available information. And for a semi-strong form, it not just include the past information but the current public information. And for the strong form, it claims that in addition to the past information, current public information, the price will also reflect the current private information. So in short, given all available information, investors cannot consistently beat the market. However, we all know value investors such as Warren Buffett, Mario Gabelli, Seth Klarman, they all outperform the market in the long run of the last 10-20 years. So which suggests that this efficient market hypothesis does not hold true. Well, this hypothesis was based on some major assumptions, and one of them was the investors are risk averse and they are rational. So, however, as a human being, we are getting irrational sometimes, and we often make clever decisions. So when that happened, the investment decision we made might ended up with less return. So clearly, this efficient hypothesis does not always hold true, and therefore value investors, they do not believe in this hypothesis. So modern portfolio theory, it is a theory that widely used in today's financial industry, basically attempt to maximize the portfolio's expected return for a given amount of risk, or try to minimize the portfolio's risk for a given amount of return. In other words, you try to create an optimal portfolio. And in this theory, there's a concept called efficient frontier. So for all the optimal portfolios, they should be on the efficient frontier line. And as you can see from the chart, when the portfolio is without risk-free assets, such as 10-year US Treasury bonds, and the efficient frontier is a bullish shaped line. But when the portfolio does include risk-free assets, the efficient frontier becomes a straight line, which is the best possible capital allocation line here. Well, why do I mention modern portfolio theory here? Because for value investors, they do not believe in this theory. Why? Because this theory states that the volatility of the portfolio is the function of correlation of assets in the portfolio. However, so that's how this theory measures risk of the portfolio. But for value investors, they do not measure risk as the correlation. In fact, they measure risk as the possibility that they will lose the money they invest in the company. So that's why they need to perform a thorough fundamental analysis and try to analyze the economy, the industry, and also the company itself. So based on all the fundamental analysis, they will be able to figure out how many percentage my investment will go to waste. So that's how they measure the risk. They don't measure risk as the correlation between two stocks or two companies, but they measure risk, what's the possibility that we might lose money on this company. And also, they do not pay a lot of attention on the capital allocation line. As long as there's an opportunity and the price is good enough, they will go on and invest in the company.